Well, hello everyone and welcome. I'm Rob and I'm a trader. I'm here to try and explain to you or try to help you with your trading. Now, one of the big questions I always get is how can you time the market and when's the best time to get into the market and when's the best time to get out of a market, or even when's the best time to get into a trade. Now, there's no such thing as timing a market. There is, however, such a thing as a high probability trade. So if you want to look at a high probability trade, I can help you with that. But my old saying is always time in the market, not timing the market. So if you want to do well in the market, prepare to be patient. You have to be patient. You can't just expect everything to happen in a day. Now, one of my favorite indicators is the MACD, the moving average convergence divergence. Now, if you look at that, that gives you a very good idea of when and to buy and when to sell a share. Now, if you look at this, how it crossed over here, and it went up nicely, and if you follow the share price, you'll see it actually follows in that direction as well, and it does the same thing, and when it crosses back, you'll see nicely that it actually has gone back with the MACD. Once again, crossed over there, and you've got a bit of a bullish change, and it crossed back over here, and you've got a bit of a negative change. Now if you look, it's about to cross on to the upside, and if this crosses to the upside, then you can expect this share, this is Aspen, to actually move in a positive direction. Another good indicator is the 26-day and the 9-day moving average. Now the 26-day moving average on this chart is the blue one, and the 9-day moving average is this yellow one over here. The only trouble with the 26 and the 9-day moving average is it's often too late, because once it crosses, it's already moved quite a distance. So it's actually better to use your MACD for this particular type of trading. What you can use the 9-day or the 26-day moving average for, you can use it for if the actual share price itself moves through the line. You can possibly use it for that. If it goes through, you can trade in, and it goes through again, you can trade out. It's basically how it works, but it's better to use a line chart for that kind of scenario. Now, one of the worst things you can get from a moving average situation is if you look at this one here. Let's just have a look at this. Now, if you go into, this is first rand, and this is one of your worst situations when it's coming through the zero line in this position. This is a very bearish signal. This is telling you that it's time to sell. You can either go short or get out of this trade. There's another sure signal up here. You can see that the 9-day moving average has crossed through the 26-day moving average and is pointing down. There's also a lot of red candles over here, although it is starting to consolidate, and there's a lot of little sticks at the bottom here. It could be starting to get ready to turn back. But while this chart looks like this, I wouldn't get into it at all. You'll also see if you put a trend line across here, and we can do that. Let's put a trend line in just so you can see nicely. If you were to put a trend line along this area here, you can see it's broken the support and it's gone below the support. Now it's going to go back up to test this support, which is now resistance, and if it comes back from there, it could actually come back quite a lot. I mean, you could see this thing coming down to 51 rand or something like that in the near future. So unless it breaks through this resistance again and starts to move up and starts to change direction, it'll show you on the MACD. You can also use stochastics. Stochastics are a shorter time period, and they give you a shorter time period information on that type of thing. I mean, if you look at Sassel over here, this is a nice one. Let's go and have a look at her quickly. You can see that it has been bullish of recent. It has moved up nicely. It's starting to consolidate, and it started to make a turnaround here, but you can see this is crossed downwards, which means this is a negative bearish signal. And while the signal is bearish, it's going down. Now you can see it's running under, this is 200-day moving average. You can see it's running underneath its 200-day moving average, which is always a bearish long-term signal. And if you were to put a 50-day moving average onto this, and it was to cross the golden cross through the 200-day moving average, then you could see it being bullish again. So I mean, if we look at something like this now, a line chart is actually very useful So let's go back to something like, let's have a look at this one here. Let's see what it brings up, just out of information. Now you can see Bidvest, it's been in a nice long uptrend. It's inside its trend still. It's trading within its trend. The orange line is the actual price of the share. You can see the moving average has come through the zero line, moving average convergence, and it's on its way down. It hasn't turned up yet, but the stochastic is starting to show an oversold situation. It's starting to turn, it's starting to show a buy. So if you were to look at a trade like this, you could say, look, it's in its trend. It's probably going to bounce off its support and move back up to its resistance level within that trend. It's got a double trend. You see it's got a straight line trend and it's got this type of trend as well. So I would look at this as an early trade. So you don't have to wait for it to go through the zero line. You don't have to wait for it to cross even. When it starts to consolidate and it starts to turn at the bottom here, I'll start to look at an early long trade so that I could catch this before it reaches the highs of say 320, 315. A lot of traders would rather wait and be more on the cautious side and wait for this thing to cross, wait for it to start going to the zero line, and maybe trade in maybe higher up at around the 320 levels or 318 by the time it gets there, and go long at that situation with a view to going to 345, 350. Fundamentally, this is a good stock. If it does break through the support, that could be problematic. It could carry on going down, and you've got levels down here at 277, 280, which it could reach. So one would wait for it to sort of bounce off this support level before one buys into that. So as I say, it's not timing the market. It's rather time in the market. Rather be patient and wait for your trade to play out. Putting stop losses in place is sometimes a good idea, especially if you're trading derivatives or contracts for difference or futures, as your trading is geared. But if you have got enough to hold on to your trades, it's not a bad idea to hold on to them, because you know, they eventually will play out, as you can see. I mean, if you're in this trade, for example, and it's gone against you, it will turn back up and probably go back up to the 345, 350 levels somewhere down the line if you're patient enough to wait for it. If they are, look, the financials are under pressure at the moment today. So I mean, if I was to show you another financial stock, something like the Barclays, let's have a look at that. I know this one's been under pressure for a while now. You can see it's clearly under a lot of pressure. It's in a downward cycle. You can see that the MACD has crossed here and it's moving downwards. Unfortunately, it gave you a false signal over here, and you only got a very small bounce up, and now it's crossed down again. But the stochastic is showing it as very oversold, and it's very much on a support line here. And this blue line is your 200-day moving average, which is, you know, you don't want it to really go through this 200-day moving average. You want it to stay above that, so you can consider that moving average a serious support. So if you were looking to trade this, I would watch it, wait for it to get to this 177, 176 level, and see if the MACD starts to turn and cross, or starts to look in a new direction. If it does break through this 200-day moving average, it's unfortunately pretty bearish, and it's not a good signal at all. Well, that's it for the time being. We'll be back in the near future with some more trading advice. Have a look at my training on the left hand side of the blog. You can see nicely there's a whole lot of different issues there that you can look at. If you're not sure how to trade, if you are a trader and you know what you're doing, then you don't need this. You can just read the blog and keep an eye on the updates and what's happening on a daily basis. Thanks for following, and I'll chat to you soon.